after a period where people have got used to falling rates, maybe now you're going to have to get used to rising rates for a period of time.
Kia ora, and welcome to the New Zealand Property Market Podcast, brought to you by Cotality for the 2nd of June 2026. I'm Head of Research, Nick Goodall, and today I'm joined, as per usual, by Chief Economist Kelvin Davidson. Kelvin, I think we'll summarise the MPS again now that we've had a bit more time to digest it. We'll do that shortly. But first, I want to touch on the great article you wrote last week, kind of looking at the state of mortgage rates. In particular, I guess that turning tide of rates as borrowers are continuing to come into that period of refixing over the next few months. We know we've been through this for a while, but we do feel like there's a bit of a turning tide, I guess, of the rates people have to be moving to and moving from. So do you want to take us through your article from last week, and I don't know, any of the reaction you've had to that as well, and I suppose, the key points that we're going to probably feed through to our market updates over the coming weeks as well.
Yeah. So I mean, in some ways, the message is pretty simple. We've passed a turning point for mortgage rates. So it's likely that as people take out a new mortgage or reprice their loan, at some point they're going to see higher rates. There's probably nothing necessarily kind of revolutionary about that. But I guess I was trying to just highlight the mindset shift as well. People have been used to falling mortgage rates over the last couple of years, whether they're a new borrower or somebody who's going on to a series of short-term fixes or floating and seeing those rates go progressively lower. So I think there's a mindset shift going on now. We've obviously, well, all else equal, given everything that's going on, the central scenario now is that we have passed that turning point for mortgage rates and we're probably headed higher. So new borrowers will already be seeing those rates higher than what they might have been able to get 3 months ago, 6 months ago. So for them, that's already passed. I guess what I was trying to do was dig into the numbers a little bit and what we get from the Reserve Bank and what we can sort of piece together. It doesn't allow you to answer every question because just the way that the figures are published. But it looks like now there will be, not everyone, but it does look like progressively as people reprice, they might have been on a series of short-term fixes, they might have been going lower each time. They're now potentially at a point where they might just start to see those rates go up, which I think is a bit of a mindset shift, and also has implications for the wider economy as well. You're facing higher petrol costs and higher everything else at the same time. You refinance your loan, reprice your loan, and that rate you pay might be going up. So it's just sort of highlighting that point now. There's lots of sort of unknowns here. I mean, the Iran thing might peter out. We might see interest rates flatten off or come back down again. I don't think anybody's really talking about interest rates spiking higher either. I mean, there's probably some upside to go, but no one's really talking about a big spike in mortgage rates. So I'm not thinking this will be a dramatic shift for people, but there is a little bit of a shift going on for some people. And so, for example, just running the numbers, if you took out a 6-month fix 6 months ago, and now you shifted to a 2-year fix, because we know that that's what people are doing. There's a big shift out to those longer term rates, and a 2-year fix is very popular. If you did that, your mortgage rate might go from about 4.8% to somewhere around 5.1, 5.2. That's in that scenario. So a 0.3, 0.4% lift in terms of that mortgage rate being paid after a period where you've probably been seeing it go down. So that is a bit of a shift. Now, not everyone will be seeing that because, of course, you just looking at the numbers, you can go from a 6-month fix 6 months ago to another 6-month fix now, and your rate even might be down slightly. You can go from a 1-year fix 1 year ago to another 1-year fix now, and you might even see a similar rate or even a slight fall. So it's not like everybody's going through it right now. But there is going to be that shift going on for some people where, say, for example, you did have a 6-month fix, you now go to a 2-year fix because you want to lock in a bit of certainty and potentially avoid even higher rates later. That's, I guess, why you go for a 2-year fix. There will be an increase coming through, and that'll spread out to more and more people as they go through this next sort of 6 or 12-month period. So, again, I don't think it's going to be dramatic. No one's talking about a big spike in mortgage rates, and you can change your behaviour potentially to avoid a big lift in rates. You stay short, and maybe you take a punt on avoiding those higher rates later. Maybe if Iran peters out and rates come back down again or flatten off, maybe you can sort of play the system a little bit. But the common choice at the moment is to go for a 2-year fix. And if you were on, say, a 6-month fix 6 months ago, that rate will have probably gone up. So yeah, it's a reasonably simple point, but it just some people will already be seeing that change. And I think even with unchanged mortgage rates from here on, even if they stayed stable, which they may well not, it looks like they might head up a bit further, that sort of rate change or that increased rate will spread to more and more people as they reprice. So yeah, it's got obviously implications for household finances, but also that wider economy. Reduced ability to spend on other things if you're putting more of your money onto that mortgage. That has economic implications, and we know that this is going to be a significant thing because there's currently about 10% of debt is floating, and latest numbers about 31% of debt currently fixed, but due to reprice in the next 6 months. So you've got 40% of mortgages are kind of exposed to this in the next 6 months in an environment where rates are, if anything, sneaking higher. So yeah, there's lots of other detail in that pulse, but in the end, relatively simple point that after a period where people have got used to falling rates, maybe now you're going to have to get used to rising rates for a period of time. So yeah, and that's where the conversations kind of went. It was just sort of trying to put some numbers around it. It's going to be different for everybody, and you can obviously avoid the worst of it maybe by staying short now, but then you take a risk that you have to pay even more later. So, those sort of normal decisions for people when they reprice it are still really relevant, but it could be into an environment where rates are going up. So, yeah, tricky decisions.
No, I think it's a really well explained situation because, yeah, like you say, the data is not exactly structured perfectly for this. And you have to basically put in those scenarios to say, yeah, what have people been doing? Heaps of 6 months short. Let's go for 2 year. Let's look at the change in that rate over time, the 6 month compared to the 2 year, put it on a chart, right? And I've got that chart in front of me, and it's really easy to start to get that idea. But I think you've done a great job at explaining exactly that article, those charts themselves. But I will leave a link to the full article, so do go check it out. Take that time to digest it. But I think you've done a great job. And I think the important thing, the reason I think it's important is because, yeah, it has been, we talked about, over the last few years, the, lag in monetary policy loosening. So as interest rates drop, as the official cash rate is falling, we know it takes some time for that to flow through to people spending, because that's effectively what it is, right? Put more money in people's back pocket. Interest rates are lower, less money servicing debt, put more money in your back pocket, go and spend that money in the economy and see the economy grow off the back of that, right? Now, that's the simplest explanation, I suppose, of how monetary policy is supposed to take effect. And we know in New Zealand it takes some time because we do fix our rates. Even when we go short term, even in a time when interest rates are falling, we still take that 6 month rate. I know we've seen a lot more people this time around go floating, but they don't tend to float for long periods of time. They tend to float for 1 month, 6 weeks, whatever it might be, until they get a little bit more certainty from the Reserve Bank in terms of what their future looks like. Then if they do think rates are going to continue to fall, take the 6 month. If not, you might start to push longer. But I think that conversation has been pretty consistent over the last wee while. We've been saying we're still waiting on the effects of monetary policy to take effect. People, as they refix, they've taken those short rates, they've been coming down. Yes, interest rates stopped falling, in November last year. So now it's over 6 months ago. So it's not a story about interest rates turning around. It's about this actually flowing through to mortgage payments. That, to me, is the big connection, right? Because, if you said interest rates are going up, people are refixing on higher rates, they're like, yeah, but interest rates have been going up since November or December. So, of course, that's the case. It's like, not quite, because still some people might have fixed for 2 years, 2.5 years ago. And as they refixed 6 months ago, they would have been getting a lower rate. And that still could have been the case for the last 6 months for many people who were on 6.5, refixing now for 5.5. But I think now is the point, is that it's starting to turn. And if you see it on a chart as well, you can see those, as I said, trying to capture people's potential common behaviour, which, as I said, could be a 1 year, just rolling on the 1 year every year over time. When you sit on a chart, you start to see it turn around, and now you start to see it hit that 0% mark where the new rate will be higher than the old rate. Not quite there for the 1 year to 1 year. That's the one that I think is the driving of the conversation here. And for those that are in the market, you'll already be having this conversation. You'll be looking at your current loan and which part's coming off and which part's coming off in 6 months. Hopefully for your personal situation, you've done this anyway. But I think from a broader market perspective, it's really useful because I've been saying in these market updates, for the last wee while, we're still to see some effect of this. We're still going to see some people feeling with a bit more money in their pocket. Now, we have also seen through this time, people haven't been spending that money they're saving on debt payments in the economy because of uncertain labour markets. And so that's why I think we termed this year the year of rebuilding confidence, because as we expected and did start to see some confidence come back in the economy and that flowing through the labour market, we expected those people that were saving a bit of coin and maybe had saved a bit already, they would be out there spending money, going out for dinner, buying those big household ticket items. But of course, the war in Iran has changed that completely. And now we're saying, and you know what? Next time you come to refix, you're going to be actually seeing less money in your pocket. So of course, that's going to have a negative effect on the economy. And that's just going to have this worsening effect as we move throughout the rest of this year as well. So for me, it's kind of like, we're expecting to finally see some reprieve as the confidence built. Now we're seeing that confidence knocked. And now we're actually talking about interest rates going up and that effect of the interest rates going up, having people's mortgage payments going up. And suddenly you're going to really start to see that drag on the economy, which will, if you want to see a positive, slow down what the rate of inflation looks like too. And that's where the conversation, of course, comes in about whether we need to do quite as much with the official cash rate, which might lead us nicely to our, second review of the monetary policy statement from last week from the Reserve Bank. The official cash rate decision, of course, to hold. It was a 50-50 split vote, casting vote from the Governor, Bremen, meaning that it did hold flat, but, almost certainly paves the way for a lift in July. So, Kelvin, now you've had a bit more time to digest that, maybe look at some of the market reaction, whether that's interest rate changes, some of the different economists out there, some of the commentary from the media organisations as well. I don't know, how do you reflect on that? Any differing conversations you've had since, we had the property podcast last week anyway? Quite quickly afterwards, we did take quick time to digest that, but had a busy Wednesday afternoons. It didn't take much time. Is there anything else on your mind we might have missed in the conversations you've had since then? I know you were at an event on Thursday, Friday in Auckland, so I saw a few people up there. Any other market reaction? Anything you want to cover off on the Reserve Bank's call last week?
There's not a lot, to be honest. Yeah, I mean, I think we did pretty well in that instant reaction. Just sort of, there was a lot to take in. Yeah, it was a busy sort of half hour, but sort of feels like, you interpret the charts, interpret the spreadsheet. I think the message probably hasn't changed too much. Is that, they sort of held fire and they're still wanting to kind of see that evidence of second round inflation, which might not necessarily be coming through by July. It might not be obvious, but just that split vote it was on such a knife edge that you feel it wouldn't take much to tip it to that rate increase that now looks pretty certain for. I'm not actually sure of the date in July. Must be kind of mid-July, somewhere around there, is it? But so not a whole lot to add. I mean, I did sort of have a bit of sort of devil's advocate sort of thing. Well, if you're going to increase in July, it's not that far away. Why didn't you just do it in late May? There was that. But I think it was probably still the right decision. It's just take a little bit more time, give this thing a little bit more chance to play out, and then see how things look in early July. Because of course, I mean, the big question still here is how long this Iran situation goes on for. I mean, it sort of ends fairly soon. Let's hope. In that scenario, well, the economic forecast from the Reserve Bank and projections for official cash rate and the economy, that they change again probably. So, everyone's kind of working in this really, really, really uncertain environment. So, as things stand, yes, July OCR increase looks pretty likely, but who knows what happens between now and then? The game might change again. So, those are probably the only things I've been thinking. It's I think that podcast from last week probably still largely stands in terms of the message, though. So, we'll see.
Yeah, the only thing I'd add, I think reading Kiwi Bank's economic note following it, they, pretty much conceded the chances of their suggested and wanted hold in July seem very low. Whether that changes their sort of rhetoric and keeping on saying that's what they think should happen, I'm not so sure. But they certainly conceded that. I thought the interpretation I was at the the inaugural credit risk and fraud conference in Napier on Thursday, Friday. They were on Wednesday as well. I spoke on Friday morning, and just after me was Cam Baggery do his economic update. I think it was in that conversation where he sort of made the point. What was interesting was, and I think we talked about it because Brad Olson had tweeted it not long after the decision, really just putting a bit more emphasis on the fact that the internal members of the committee at Reserve Bank voted for the hold, the external members voted for the increase. And Cam's interpretation of that was those that are external to the bank might be closer to actually what's happening in the economy. And so if they were seeing something different, maybe it's because they are closer to the realities of what's happening in the economy, where inflation is really high and starting to hurt. whereas those internal members might not quite have that same feeling because they're not out there as regularly. Now, I don't know if that's a fair assessment of the way those members are and how connected to the economy and businesses they are. I don't know if that's fair, but if you assume that is, then that was an interesting point, right? And if you go, yeah, well, if they're close to the economy and the economy is feeling this increased inflation and feel like we've got to do something about this, then maybe that just even further drives home the point that, yeah, we're going to see this because businesses actually, wearing this higher inflation and need to see the OCR increase off the back of that. Maybe not. But that's the only sort of probably extra additional thing I'd talk about. I can't remember if we actually had the figures for the updated sales volume forecast model, but certainly if we didn't talk about it on Wednesday afternoon, I know we've got the data now. Do you want to just run through the updated actual numbers from that? Because obviously, that's a sales volume forecast model. It's a genuine model. Most of the inputs are things like interest rates, economy, migration, labour market stats, wage growth, or whatever. It's these things that are all updated at the monetary policy statement time. So we've updated the official model. Previously, of course, we're expecting around 100,000 transactions this year, up from 91,000 last year. What are the updated figures tell us, Kelvin, for particularly this year? But I know it updated for next year as well.
Yeah, I mean, so the two, there's a few variables go into it, but the two really big ones are mortgage rates, as you'd expect, and just the health of the economy, GDP growth. So, yes, we previously had a projection that sales would go to about 100,000 this year. It's kind of a 10% lift, more or less, from last year. Now, with the higher projected path for mortgage rates and a lower projected path for the economy, we've pretty much removed about 10,000 sales from that projection. So actually now, based on current numbers, the housing market would do pretty well to stay at about 90,000. It seems like that's what will track sideways in terms of sales volumes this year compared to last. So yeah, not I suppose great news for anybody wanting to see more activity in the housing market, estate agents or valuers or whatever it is. But I've kind of just in the short chance I've had to talk to people just after those numbers were updated not long ago, so I haven't had many chances. But I've just been trying to put the message across that, well, yes, it's less than what we were thinking, but 90,000, early 90s, it's kind of not too bad historically. It's kind of about average. So, it's not all doom and gloom. So you're not talking about a return to 22, was it, or 23 when sales got down to sort of 65,000. So, it's kind of tracking sideways from where it was last year and just reflecting, higher interest rates, lower economy. So no surprises that sales volumes wouldn't grow as strongly. And then, I mean, into next year, it gets a lot more uncertain, but, potentially just going a little bit lower next year and reflecting the sort of lagged impacts of higher mortgage rates, maybe still a slightly sluggish economy. So it could be that, sales go a bit below 90,000 next year. But, generally, I think we're probably just looking at a couple of flat years. Now, a lot of uncertainty around that, of course, as I said just a couple of minutes ago. Who knows? Iran might end shortly. Maybe interest rates don't go as high as what currently looks likely. Maybe the economy recovers quicker than what currently looks likely. In that scenario, you could imagine that sales actually go a bit above 90 this year, and don't actually fall a bit next year, and instead actually rise as maybe mortgage rates are a bit more supportive and the economy is a bit more supportive. So all I'd say, I guess, is that there's wide error margins around this at the moment, and in terms of a story, maybe we don't get too sort of tied up on the actual point numbers, but in terms of a story, kind of flat this year for sales, maybe down a little bit next year, but still sort of flat. And then just watching the economy. If Iran obviously ends sooner rather than later, maybe you get a bit more growth coming through. So it's probably more of a, even in a negative scenario, you have sales relatively flat. If things resolve themselves, then we're looking at growth again. It's probably that sort of message I'd get across.
Yeah, I think so, Aisha. It's a good point. And I think that's one other one to reiterate from Wednesday's chat is the Reserve Bank sort of, putting out their central expectation of the war in Iran lasting months. Now, again, it's pretty broad terminology in itself. But again, I think it just shows that, for any predictions or setting expectations, that we do have to expect this goes on for a bit longer. Again, over the weekend, we've sort of seen, chat about more ceasefires, and then we've seen it escalate once again. So it does feel hard. It does seem hard to feel like this is going to, end tomorrow or next week. And again, as we've spoken about over and over again, the longer this disruption goes, the greater impact it's going to have, not just on economic growth, but on supply of oil. And then with the genuine change in behaviour, and we talked about this last week as well, in terms of spending down on our petrol. So, we are seeing that change in behaviour, but it might be even more significant down the track. And that kind of also, to me, I think since Wednesday, the other thing that jumped out to me was it does feel like the economic forecast from the Reserve Bank still seems pretty optimistic. Looking at the chart, you can sort of see that their quarterly GDP forecast, yes, it drops away over the next quarter or two, but it sort of just only gets to 0%. It doesn't really drop into the negatives. They're not forecasting a recession. Annual GDP sort of hovers around the 2% growth rate, a little bit volatile for the next sort of 4 quarters or so before it then starts to grow consistently up to this magical 3 to 4% rate, a year or two away from now. And to me, I don't know, it still feels pretty optimistic given we haven't seen, much growth in the economy over the last few years. Yes, we start to see some signs of it rebounding, but not to any strong degree. And I suppose there's 2 things from that for me, that it probably shows why their expectation is they can lift the OCR next month, because if the economy does remain relatively firm, then it wouldn't be too concerned about raising the official cash rate if the economy is still relatively robust, because you're not worried about that destructive demand occurring too badly across the board. But also to me, maybe if they are that optimistic, then, maybe as we get more data, they won't be able to lift the official cash rate as aggressively later on in the year if they're not going to see the data as they expect. So, maybe we do see the lift sooner rather than later, because it feels like that's their path of least regrets. Get onto it earlier. Worse that we have inflation stick around longer. But if the economy does suffer more than they expect, which to me won't be hard because they are very optimistic there, then we might see some dialing back of that, or dialing back of the expected increases sooner than we think as well. So, I don't know. There's a few things I'm just sort of leaning towards with that one. Still expect that increase next month, but maybe we don't see the next 2 occur at the next 2 decisions after that. Maybe it's only one, or maybe there's a pause before another one. I don't know. And again, we're getting into pretty speculative territory. It is all very data dependent. They are very clear they're going to wait and see how the data plays out on this, and at least they're putting more weight on these more frequently updated data releases rather than just waiting for official releases of GDP and employment data and CPI data. They are happy to act on the more recent frequent data sets, so that's a good thing as well. So, look, there's still plenty of interpretation either way on this, plenty to continue to watch for. It doesn't feel like it'll be that far away for the next decision. No, we won't get the updated forecast, but we'll still get another statement from them. So, we'll be able to see their take on the latest data as well, and that'll be certainly a very, very interesting one. And again, if it goes to vote, will there be any, of the committee members holding back? We'll wait and see on that too. Plenty to watch out for. Let's just stick with Reserve Bank very briefly, Kelvin. I know last week we did get some more mortgage lending figures from the Reserve Bank for April. I know there's a bit of data in there. I think the one thing that jumped out to me was just, when you look at the breakdown between investors and owner-occupier, and this is all kind of flattening out in general, I suppose, across the lending figures. But, is there anything from that or the other data from that mortgage lending released last week that you wanted to touch on before we maybe just look at any other news in particular around the government budget released last week?
Yeah, no surprises, mortgage lending slowed a bit in April. So, given everything that's been going on, higher mortgage rates, less economic confidence, there's probably no surprise there. And mortgage lending has been growing for a good couple of years now, so no surprise you get a slowdown at some point. Volumes are still pretty decent. We had about $8 billion of new mortgage lending in April. But as I say, bit of a slowdown in growth. It was only 0.4 billion higher than the same month last year, which is the smallest growth in pushing 2 years, so 20 months ago to be precise. So there is a bit of slowdown coming through there in mortgage lending volumes, but of course no surprise given everything that's going on. Probably driven to some extent by investors, a little bit softer than owner occupiers, but then maybe in the previous few months investors have been a little bit stronger, cashing in on slightly looser LVRs at the tail end of last year. Looking to get in at reduced prices, maybe looking ahead to the election, thinking, gee, maybe I should make a purchase now. And we're seeing that in buyer classification, of course, as well. So, it's perhaps reflecting a little bit of growth previously, that maybe investors just pulled back a little bit in April, and nothing major. It's a little bit of a gap there between investors and owner occupiers, but nothing major. So I think overall the message is probably simply that there's a bit of slowdown there. No surprise because of everything else that's going on. Just touch on bank switching. Those volumes were a little bit softer as well, but still higher than where they have been sort of previously. So there are still people switching, and it fits with what we talked about earlier around that sort of still reasonably short structure of existing debt. You have the ability to switch if you want. Maybe not so much as they used to exist. I mean, the cashbacks aren't as big as they used to be, all of that. But so I think there's probably still a window here for people to switch. But it's probably, that sort of activity may not be such a focus in the next sort of 6 to 12 months because, rates are rising. You kind of lock in. Once you lock in a new fixed rate, it's harder to switch. Lots of people have already switched, so they're probably going to be tied into to new cashback sort of tie-in periods as well. So, yeah, to keep on switching is going to take a lot more. It's going to cost you more. There's going to be a lot more effort to do that. So, yeah, I suspect there'll be a little bit of focus on switching the next little while, but that window's probably not as wide open as it was, certainly in December last year when everyone went crazy. So yeah, still a bit of it. It's not maybe the same focus it used to be, but yeah, still one to watch.
Yeah, I think so. And I'm like just in some anecdotes talking to some of the people at the banks. It sounds like there are still some decent cashbacks available. Now, it's not the 1.5%. You might be able to squeeze 1 to 1.25 out of some banks. So again, certainly, I suppose the story there is to still encourage having that conversation. Ask the question whether it's with your bank themselves or going direct to other banks or through your mortgage advisor. It's certainly worth asking the question because the banks are still trying to expand their books responsibly, and they are willing to fight for good borrowers. And so if you are someone like that, decent job, good security in your job and money coming in the door, then they're going to be willing to do what they can to get you in their door, and they'll still use cashbacks to do that, but it might not be as overtly advertised as what we saw late last year anyway. So yeah, always a good message to continue to push, I suppose. All good, mate. We'll move us on then to the budget announcement from the government last week. I don't know, in terms of, I suppose, high level summarising this one, really just a reinforcement of the way this government's been talking about things for the last couple of years, continuing their line about going for housing growth in terms of, encouraging more housing stock, which, from the intent or the broader perspective, I think is a good thing. Do you want to touch on any of the detail within that? I haven't really, had too many chats about this. I don't think people have sort of focused on it too much, but yeah, anything you took out of that in particular that's worthwhile covering today?
Yeah, I think that the budget has sort of come and gone fairly quickly, I guess, in lots of different ways. But in terms of sort of the housing aspects of it, I think it was really kind of doubling down on what they're already doing, whatever the phrase is. More of the same. We're going to keep pushing supply. We're going to come up with new initiatives, but really it's part of this overall package to keep pushing housing supply. That's our big focus. So they talked. There's a few more social houses, sort of roughly 2,000 sort of new social houses going to be built. Still pushing that Resource Management Act replacement and coming out with new legislation around there, hopefully making it easier to get consent and all that sort of thing. So that's kind of just is still being pushed. And then this other measure, which is sort of basically a bonus effectively, or a commission for councils to do more dwelling consents. The more consents you do, the more money you'll get. We'll give you effectively a bonus for doing more dwelling consents. And so that's a new thing, and some pretty positive kind of reactions to that. I think whether it's a game changer on its own, I don't necessarily know, but it's part of this wider push to keep housing supply going. We're going to do whatever it takes to get that housing supply up and, help with housing affordability. So all of those kind of worthy things that this government's been doing for the whole time, really. They're just, I guess, as I say, doubling down on all of that. So all seems pretty worthy. We're going to need more houses in future, so getting that supply up seems pretty positive. You'd think that this will probably stick through the political cycle. It's hard to imagine, even if we got a change of government, it's hard to imagine Labor kind of reversing too much of this. So it feels like we are on a path now where housing supply is a bigger focus and should help with that housing affordability. So yeah, well, it all seemed pretty worthy to me.
Yeah, well, I agree, and I think ultimately it's encouraging the right type of behavior, which is, yeah, zone properly, encourage more building, and there's always been a question about how can you fund the councils to actually do that, because they continually say, yeah, fine, we can open up more housing, but we actually need to invest in the infrastructure to support that. How is Central going to play that way? And this is obviously one way. And so I think, again, if you talk about the vibe, the intent, encouraging the right behavior, it's all pretty good. I'm sure there's conversations about, is it the right number of social housing? And yes, we're going to have arguments about the right types of RMAs or X replacing RMA to ensure that we do it correctly. I'm sure there's debates left, right, and centre about how all that plays out. But for me, if we go, is the intent right? I mean, encouraging the right type of behaviour? I think yes. I think we saw through the bipartisan agreement that I know is not really in play anymore a few years ago between Labor and National. In general, we see that they do agree with these things. So I agree with you that, it's unlikely to see a massive change. I'm sure they all think that they can achieve the same thing, which they all want to achieve, which is more houses in different ways. So there's always tweaks and things in the future. But I do think the good thing is that across the political spectrum, does seem to be agreement about getting more supply. We know we need more supply. Long term, we need to make up for this, the deficits we've created over the past where we didn't build many properties, particularly in the early 2010s. And we know that there's forecasted population growth in the future. And so we need to continue to build properties to house our growing population. And also, one part of the equation that's often forgotten about is what does, and I don't know what the answer to this is, but what does healthy household creation look like? How often should we be creating new households from existing households? That means people moving out of home, with their parents. Or you're in a flatting situation with multiple people, I don't know, 3, 4, 5, 6 people living in a house. And at what point do those people feel financially capable and willing to move out on their own or as a couple? And that's household creation, which is really hard to get statistics on this. And so, it's not as easy as just going, what's migration coming in? How many houses are we building? We're building X houses per people, happy days, right? Like there's so many other factors we need to take into account, let alone how that's gone historically to try and find out some equilibrium we're in right now. So I still believe that we need to continue to build more, enable more houses where people want to live, supported by the right infrastructure, in places where there's already, strong community support, schools, parks, all those things that people want to live close to. We still need to keep doing more. And at least this government has continued to double down on that thinking to say, yep, more properties is good. And also it's going to mean that the growth in property values over time will be reduced on where it would be otherwise if we didn't build as much as we were intending to. So, yeah, I think in general, that's my take on it. No doubt there's arguments as to how you go about that, how fast you can do that. And again, the balance between social housing, affordable housing and open market housing, again, massive debates on that, but let's leave that stuff alone for now and go, yep, in general, when it comes to housing, let's continue to build more. I'll go with that as the high level benefit and best thing from it. And I think that's all we can really say on that. So, yep, good to see. And I'm sure there's plenty of detail within the budget, among other things as well, that people can pick out. But that's the main focus I had anyway. All good, mate. That pretty much is us for last week. And look, there's been plenty. We've been going for over half an hour now. So we will need to wrap things up. This week, I suppose we do have the May Home Value Index. So that's going public on Thursday. Any early tweaks of insight you want to take from the weekly HVI from the website, Kelvin?
Yeah, I think I'm going to have to write it in a fairly entertaining way because the data itself might be pretty middle of the road. It looks like the national figure might be reasonably flat as it's been for the past couple of months. Really, they're not saying that's a bad thing, just saying that more of the same doesn't make for such an interesting headline. So yeah, kind of flat. I mean, Auckland might be sort of flat, Wellington down a bit, Christchurch up a bit. So it's probably mostly a continuation of what we've been seeing for a while. But yeah, I'll have to think up some interesting catchphrases to make it a bit more interesting to read because it could be reasonably flat. But like we say, two sides to the story in the housing market all the time. Some people are disappointed about that. Some people are really pleased about that. So yeah, we'll see what the numbers reveal in a couple of hours' time.
Yeah, and when the high level data is pretty flat, there's always some devil or some interesting information in the detail, right? Whether it's by property type or property size, which is the great thing I suppose we get to do is go and spend a bit of time getting beneath the surface and finding out what's happening in some of those more micro markets as opposed to sticking quite macro in those city sizes themselves. So yeah, I'm sure there'll be plenty of detail to extract from that, and it'll be published on the website by Thursday. Certainly be feeding into all our presentations during the latter part of the week and into next week. So yeah, yeah, keep an eye out for all of that anyway. But otherwise, mate, that'll do us for property and economic chat this week. So if that's all you're here for, we will catch you all next week. But otherwise, Kelvin, we did, of course, enjoy a long weekend. How did you guys make the most of that? Any key things to report home about, or did you catch the much sport? Pretty boring round of Super Rugby, and obviously the Warriors had a great top of the table clash, but didn't quite get up. But does maybe set up the rest of the season to show they're definitely a contender. Yeah, what's on your mind otherwise?
Yeah, not too much to report. Pretty quiet. We didn't go away, so we were just around home. Yeah, I found that Crusaders Hurricanes game a bit disappointing. It's sort of, when you know it's one team's selected a weakened side, it kind of takes away the integrity of it a wee bit. So yeah, that's a bit disappointing. But we'll look forward to to proper games coming up this weekend. Some decent NRL games, so enjoyed that. But yeah, I don't know, we were just around home doing bits and pieces. Probably the highlight for me was a full shed of firewood. That's always it's been really warm around Canterbury. I mean, amazingly warm and dry, but you always know it's going to get cold at some point. So it always does a lot for my mental health to know, look, I've got a full shed of wood, perfect. We'll be good when the frost set in. So always a highlight. Might not be everyone's cup of tea, but there was a highlight for me.
Well, good,
so,
good.
Yeah.
Good physical workout too, mate, which obviously helps to get the endorphins going, I guess. So, yeah, fair play.
Yep. No, all good. Yourself?
Yeah, well, we actually did manage to get away. We've got some friends who had a batch up the coast in Waitarere. So nice to just go and spend some time up there. Similar age kids to ours, so the kids sort of keep themselves occupied and less questions about watching TV and getting on devices. So it does feel like a bit of a hark back to, our childhood of the 90s, I guess, going back to those little beachside towns, and weather was good. A bit of drizzle coming in yesterday, but otherwise was pretty nice. We didn't get there till Sunday, so it was only one night away after sort of our usual sport on Saturday. But yeah, just great to be away. And yeah, the drive home back to Wellington yesterday was certainly filled with, why can't we have 3-day weekends every week? Or, do we even have to go back today? Can't we have tomorrow off? But unfortunately, reality is here. We do all have jobs and they do go to school. And so we are back into it. But yeah, nice to have those, that little breakaway anyway. So very thankful for that. From our football perspective, look, as we suspected over the last week, we have solidified our spot in the top 4 for this Masters 1/2 division. So regrade happens now. Top 4 from each pool goes through to the top 8, which effectively is Masters 1 for the rest of the season. That includes our team. Can't say our guys are too happy about it. It's going to be some tough games. Games we've already lost to some teams at this level, 8-0 and 6-0 this season. So going to be for some tough games in the second half, but a couple of games will be very close. So we're just going to have to, enjoy those ones and step up to those big boys. We're just going to have to find a way to be competitive. So yeah, there's going to be an interesting one to play out. But it is what it is. Nothing we can do about it now. And yeah, just enjoy it and enjoy the social times. We played at Nine Saturday afternoon, go into the club rooms afterwards, good vibe. Both teams were in a good spirits and, good interaction between. And yeah, that's why we're there. So I'll certainly be putting more emphasis on the post-match beverage and yarns that go with it. Because it sounds like the times on the field might be a little bit more difficult. But yeah, that's pretty much all on my mind anyway, mate. Certainly looking forward to the Super Rugby playoffs. Still that weird game where one of the losers is going to stay in the game. But as long as it's not the Canes, then they'll lock in the home semi-final the week after. I'll be going along to the qualifying final on Friday night. So yeah, firmly invested in that. And here's hoping they can make it all the way through to the final. But don't want to get too far ahead of myself. But that's certainly the hope right now anyway. So here we go.
Yep, nice one. Look forward to it too.
Cool, mate. Well, that'll do us for today. Thanks, as per usual, for your thoughts and insights, mate. Always appreciate our chats. Tuesday morning or Monday morning, always very useful. Just leaves me to say thanks very much again. Thanks for listening. Please do get in touch with any questions or feedback. What's going on in your world. Keen to hear about that. But that'll do us for today. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.